Dear viewers, hopefully you're doing very well. Today we'll talk about the money market, and I am Dr. Sharat Khandaka who will give this lecture. So first we'll think about the role of the money market. Money market are a collection of market each trading a different short-term financial security. Money market trading takes place over the counter, which is OTC, according to particular conventions. The trading is facilitated by dealers who stand ready to offer buy or sell quotes to potential customers, and it is also interesting to know that if two parties agree to disagree, the usual conversation, they're free to do so. So the money market is over the counter market. It's a collection of markets, so it can take place anywhere of the world. It can take place in the company boardroom, it can take place outside of the company, it can take place any other predetermined place. So it is a collection of the market rather than a particular market. For example, if you think about the stock exchange, ASX has a physical location, whereas the money market, we do not have any particular physical location. This should be noted that the money market are wholesale markets where the trades are typically valued at more than $1 million. Transactions on the money markets are called open market transactions because of their impersonal and competitive natures. There are no established customer relationship in the money market. This is also to note that the settlements usually take place through the clearing house Clear or the RBA information and transformation system. So what are the instruments of the money markets, and what are the characteristics of the money market instruments? First of all, the main characteristics of money market instrument includes low default risk, because money market instruments are for the short period of time. As we know, the money markets are typically for more than 1 year, and most of the money market instruments are discount securities, so most of the money market instruments are having low default risk. Second, the money market instruments are highly liquid and highly marketable, as most of the money market instruments are issued for typically 30 days to 180 days. These are not long term but short term, and there are lots of investors in the money market. Therefore, the products in the money markets are highly liquid and marketable. Third, money market instruments are large in size or large in dominations, because this is a wholesale market and typically costs are very low for the transactions, so this is large in denomination. And the fourth is low per dollar transaction cost. So money market instruments are having very low transaction cost per transactions. Now I will show you one chart which has been taken from the ASX, that what are the transaction cost for the money market instruments. In this chart we can see the money market instrument transaction cost, and we can see that most of the transactions in this chart are listed are about $3 or $12. If you go down, you can also see that money market transaction costs are very low compared to the secondary market. Now this file has been already uploaded to the Blackboard or the Canvas site for your reference. So why do money market instruments have these characteristics? First of all, because investors are looking for safe short-term investment, and the money market instruments are issued by economic units with the largest credit standing. Second, temporary investment need to be very marketable. In case of money is needed unexpectedly. So money market instruments are very liquid in nature. These are short period of time, and it can be sold to the market at any time. And third, it only costs, as I showed to you in the previous chart, that it only costs $3 in fees to trade a line of securities in Australia, and this could be a transaction worth up to $100 million. So think about it, up to $100 million of transaction, the cost could be only $3. Therefore, money market instruments are having very low default risk. These instruments are highly liquid and marketable. The large in denomination in the money market, and the money market instruments also have very low per dollar transaction cost. This slide is showing turnover of money market instrument from July 2010 till June 2011. If you can see, the turnover of the money market instrument that includes Australian government T-note, which includes about $41.2 billion, state government or semi-government paper $51.2 billion, bank bill and negotiable certificates of deposit $3.2 trillion, and it includes some corporate papers which is about $378 billion, and the remaining are repos. So now we look each of the money market instruments more closely to understand the characteristics of these instruments, and we all also know what are these instruments and how we can do the calculation to find out the value of these instruments. So the first instrument in the money market we'll talk about is the T-notes. T-notes are the treasury notes, are issued to finance the operations of the Commonwealth government. T-notes are short-term instrument, and this is a short-term discount security, and maturities are less than 1 year. Because of the government surpluses in Australia, no T-notes were issued during 2003 till 2009. However, the sanction left after 2009, and the government is issuing more and more T-notes in the market. And around 2010, the volume of T-note issued was peaked to approximately $25 billion. T-notes are auctioned by the Australian Office of Financial Management, which we can also call AOFM in short. Bids usually by large investors are submitted competitively, and the bid with the lowest yield are accepted first. Now this is a very interesting thing. The bids in the T-note bidding process are accepted first. The reason behind it is at the lowest bid, more money can be raised from the market. We'll see some calculation based on this point, that the bid with the lowest yield accepted first. However, any remaining or subsequent T-note will be sold to the subsequent bidder based on the percentage of yield they offered. The pricing of the T-notes, as T-notes are sold on a discount basis and pay no coupon payments. Therefore, the pricing formula of T-notes are very similar to the zero coupon bond formula, which is presented in the following slide. So P is the price divided by F is the face value, 1 plus Y multiply N divided by 365. Here Y is the yield and N is the number of days the T-note is going to mature. This slide will discuss about the cash rate market. The cash market is the market for the cash held in the exchange and settlement account at the RBA. The cash market is the market for cash held in the exchange and settlement account or ESA at the RBA. This market allows commercial bank to borrow or lend excess ESA balance. The relevant interest rate in this case is the cash rate. Interbank borrowing and lending makes up most of the cash market transaction. So when the exchange and settlement account transactions take place, one account is debited for the cash market and one account is credited in the exchange and settlement fund. As we know, most of the bank invest in the government security, as the government security increases the quality of the bank balance sheet. Sometimes the bank can use the repo transaction in order to borrow money from the another bank, and generally repos are used government security as a collateral. So what is a repurchase agreement or repo? A repurchase agreement or repo is an agreement involving the sale of a government security or a security with the condition that the seller will buy it back at a predetermined price. The securities involved are generally the CSG or the Commonwealth Government Security and the semi-government bond. Repos are typically made for one day and usually no longer than a week. So from the point of view of the buyer, the repos is a source of short-term funds. From the point of view of the seller, repos are a short-term investment. Now, how does it take place? In this slide, the process of repos is being explained. So if you look at in this table, we can see that there are stages of the repos. So before the creation of the repo, creation of repos and completion of repo agreement, bank A, which is a hypothetical bank, and bank B, which is also a hypothetical bank. Before creation of the repo, at the first stage, bank A has excess $1 million deposit and bank B need $1 million. So bank A can allow to give this money to bank B if they need this money. However, bank B has to use its government security to create for the creation of the repo. So if you look at in here, bank A can give $1 million deposit, so which they have $1 million extra money, they can use it to fund the repo, and bank B need $1 million deposit, so they can create a repo and to sell. So repo is selling the government security and promise to buy it back. So in the creation of the repo, $1 million repo with the Commonwealth Government Securities as the collateral. So when the repo will be created, bank A will receive $1 million repos with the Commonwealth Government Security, and as bank B sells its repo, so sells its government security promising to buy it back, so $1 million will be deducted, which is a collateralized loan. After completion of the repo, which is the stage 3, $1 million deposit plus the interest which the bank A will receive. Why? The reason behind it, for the point of view of the seller, repos are short-term investment, so they're investing the money, so they'll be looking for some interest. So bank A invested $1 million as a repo to bank B, so they will receive $1 million deposit at the creation of the repo or the completion of the repo plus interest amount, and then $1 million deposit or the repos will be gone. So bank B, they have to, after completion of the repo, they have to pay $1 million deposits plus the interest. So this table is basically explaining how the repo can be created and what are the different stages of the repos. For both the bank A and bank B, repos help both of them to manage their liquidity. So what are the yield on repo? The rate charged on repo is negotiated between two parties, which is Bank A and Bank B. Because repos are collateralized loan, the yields are generally less than the cash rate, which is uncollateralized. The calculating on yield of repo will use this formula, which is I equal to P multiply R multiply N divided by 365, where I is the investment return, P is the price, and R is the rate, N is the number of days the repo will be created. So let's look at an example. Assume NAB does a reverse repo with NZ Bank, which needs funds for 3 days. At the prevailing cash market rates, NAB offers to buy CSG or the Commonwealth Government Security from ANZ Bank and to provide it with $1 million of cash, and also promises to sell the securities back to ANZ for $1,410.95, which includes $410.95 as an interest. After 3 days, the yield on the reverse repo will be, and we'll use this formula. So if we rearrange the formula to get the yield on repo, which is R, so which is R equal to I, which is the investment return, divided by P is the price, initial price of the repo, multiply N divided by 365. So the yield would be 410, which is the investment return as it's said in here, 410.95, divided by 1 million multiplied 3. 3 is the 3 days the repo has been created, divided by 365, and we can get a result of 5% return. So this is how we'll calculate the yield of repo. So repo is one of the most important instrument for the financial institution to manage its liquidity in the money market. The next instrument in the money market is the bill of exchange. A bill of exchange is a discount security issued with a face value payable at the maturity or the future date. A commercial bill is also a bill of exchange issued to raise funds for general business purpose, and a bank accepted bill is the bill that is issued by a corporation and incorporates the name of a bank as an acceptor. So if you look at the commercial bill, the bill of exchange, it has two different parts or two different types, we can say. So the bill of exchange, the one type is the commercial bill, and the second type is the trade bills. If you look at the commercial bill has three different types. One is the bank accepted bill, two is the bank endorsed bill, and three is the non-bank bill. Therefore, the first category of the bill of exchange is the commercial bill. In the commercial bill, there are three different types as I mentioned earlier. First is the bank accepted bill. So a bill is issued by a corporation that also incorporates the name of a bank as an acceptor is called the commercial bill or the bank accepted commercial bill. By putting the name of a bank as an acceptor, the bill became more creditworthy in the market. However, when the bank will put its name as an acceptor, bank will charge some fees as it's the fee-based income for the bank. The second type of bill of exchange is the bank endorsed bill. When the bank was the previous holder of the bill and signed the reverse of the bill when selling it to the money market, that is called the bank endorsed bill. Most of the endorsements today are now electronic record of transaction. So basically, bank endorsed bill means bank was the previous owner of the bill. So endorsement is basically the electronic record of ownership. When the commercial bill became the bank endorsed bill, it became more creditworthy in the market, as the bank was the previous holder of the bill, which certainly suggests that bank only invest in those types of bill which are more worthy and have good rating in the market. This is the specimen of the commercial bill, and it includes the features of the commercial bill and the parties involved. So in the commercial bill, the date would be included in this part, accepted, the date of the acceptance to ABC Bank, and the other information has been provided. And in this part is showing the total value of the bill. The parties involved in the commercial bill includes the drawer, which is the issuer of the bill, or we can say it is the corporation. They also have the secondary liability for the repayment of the bill after the acceptor if the bank fails. The second parties of the commercial bill is the acceptor, and generally this is the bank. So the acceptor undertakes to repay the face value to the holder of the bill at the maturity, and acceptors are generally the merchant bank or the commercial bank. The third party of the commercial bill is the payee. So the payee is the party to whom the bill is specified to be paid. It could be a third party, and this is the party who will receive the fund. Usually the drawer is the payee, but the drawer can specify some other parties as a payee if they wish to. The fourth party of the commercial bill is the discounter, the party that discounts the face value and purchase the bill. Now this is generally the bank, or this could be the third party as well. They provide, or the lender of the fund, and sometimes they can also accept the bill. The last party that can include in a commercial bill is the endorser. The endorsers generally sign the reverse side of the bill when selling it or discounting the bill. Now this is to note that the endorsement creates legal chain of the ownership of the commercial bill. So what are the advantages of commercial bill financing? So the first advantages of the commercial bill financing is the lower cost than other short-term financing, that is overdraft or the fully drawn in advance. Now, as the bill is issuing to the money market and it doesn't require a significant amount of issuing cost, so it has a lower cost than other short-term financing. And the second advantage is the borrowing cost or the yield determined at the issue date, not affected by the interest rate change. One of the problem of overdraft facility is it can be affected by the interest rate change, but the commercial bill will not be impacted by the interest rate change. And the third advantages of the commercial bill is the term of the loan may be extended by the rollover to the maturity. So though commercial bill is a short-term financing, but when it has a rollover facility, it can go beyond the short-term limit and can be the medium-term instruments. Now from this slide we'll look different types of calculations of the money market instruments or the discount securities. When we'll be looking for the calculations of the money market instruments or the bills of exchange, our consideration will be given to the following, and we'll look different types of calculation in the money market instruments. So we look for how to calculate a price of the commercial bill. We'll also calculate the face value of the commercial bill, and we'll also try to calculate the price when we know the discount rate. So let's go to these calculations. So when we know the yield and maturity, how we are going to calculate the price of commercial bill? The formula will be price equivalent face value multiplied days in a year divided by days in a year plus yield divided by 100 multiply days to maturity, and this is our first formula. So let's look at an example. A company decided to fund its short-term inventory needs by issuing 30 days bank accepted bill with a face value of $500,000. Having approached to prospective discounters, the company had been quoted yield of 9.52% per annum and 9.48% per annum. Which quotation should the company accept, and what amount will the company raise? So we'll look, or we'll use the discount security formula to calculate the price of the bill. So if we look to the formula again to understand how we can calculate the price of these commercial bills, that will be helpful for our calculation. So let's go back. So the price is face value multiply days in a year divided by days in a year plus yield divided by 100 multiply days to maturity. So if you put all of this into this formula, so we know the face value is $500,000, days in a year is 365, divided by days in a year 365 plus yield divided by the 100. So the first quote was 9.52 divided by 100 is 0.0952, and the duration of the bill is 30 days. So the value of the bill would be $496,118.04, and with the yield of 9.48%, which is this one, the price of the bill will be $496,134.23. So by looking to these answers, as we have two quotations from two different banks, 9.52% per annum and 9.48% per annum, which yield you should accept? As if you're going to go back to our previous slide, if you remember, I was mentioning in bidding for 3 notes slide that the bid with the lowest yield is accepted first. So in this case, we are going to also accept the lowest yield, because at the lowest yield we can raise more money from the market. So let's look at it again. At the lowest yield, which is 9.48%, we are raising $496,134.23, whereas the higher yield, which is 9.52%, we are raising $496,118.04. So we will accept the second one. Hopefully you understand. So the next calculation is how to calculate the face value of a bill. So the formula is face value equivalent price multiply 365 plus yield divided by 100 into days to maturity divided by 365. So let's look at another example. A company needs to raise additional funding of $500,000 to purchase inventory. The company has decided to raise the fund through the issue of 60 days bank accepted bill rollover facility. The bank has agreed to discount the bill at the yield of 8.75%. At what face value will the bill initially be drawn? So we need to use the formula that we have seen previously. So to calculate the face value of the bill, we need to use this formula. So if you put all this information to the formula, then we can calculate the price or the face value of the bill would be $507,191.75. So how we put all of this? So first we put the price, which is 500,000. Yield is 8.75. So if you divide the yield by 100 is 0.0875, multiply 60 and 365 days. So if we put everything and calculate, we'll receive, or so if we include all this information to the formula, we'll find this answer. Hopefully you understand these calculations. If you have any further queries, please look into my other videos on calculating the price and the face values of the discount security. Now we'll look to the other instruments of the money market. The another instrument that issued in the money market is called the promissory note, or also called the P note, or a commercial paper. Promissory note is also a discount security, so we can call it as a P note or the commercial paper. This is a discount security issued in the money market and face value is higher than the price. So the main characteristics of the promissory note includes there are no acceptor or the endorsers. This is an unsecured instrument in the money market. As there are no acceptor or endorsers, only corporation with the excellent credit rating can issue P note in the market, and this is an international security issued by major corporations in the world financial market. So when we'll calculate the price or the face value of the promissory note, we'll use the discount security formula that we already discussed in our previous slide. And the issue programs of the promissory note includes the P notes are usually arranged by the major commercial bank and money market corporations for its issue programs, and during the issue process of the promissory note, it includes the standardized documentation, because this is an international market security, so the documentations are very standardized. Most of the P notes also includes revolving facilities, and most of the P notes are issued for about 90 days by the tap issuance or through the tender process. The documentation includes in the P note are a dealer agreement, information memorandum, issue and pricing agreement, supporting guarantees from the issuing companies, and liquidity supporting facilities. And this is the formula which we are going to use for calculating the price of a P note. As the promissory note is an international market security and companies need excellent credit rating to issue P note in the international market, there are different underwritten issues when issuing P note to the international market. These issues include underwriting guarantees. The full issue of notes is purchased and typically they charge about 0.1% per annum as underwriting fees. The underwriters are generally the commercial bank, investment bank, or the merchant bank. The underwriter's commitment virtually assure the borrower of a line of credit extending beyond the short-term life of the P note, and which could be up to 3 years. So the underwriter's commitment virtually assure the borrowers of a line of credit that extend beyond the short-term life of the P note. However, this can involve a significant cost. However, this is to note that the issuing process of P note may be non-underwritten. So the next types of money market instrument which we are going to discuss in our lecture today is the negotiable certificate of deposits, or in short we can say that it's NCD or just the CD. Negotiable certificates of deposit, or the CD, is a short-term discount security issued by bank to manage their liability and liquidity in the market. The typical maturities for the negotiable certificate of deposit is about 180 days, and the NCD is issued to institutional investor in the wholesale money market. And this is to note that the short-term money market has an active secondary market for the CDs. So this is an instrument which is generally issued by the commercial bank in the money market, and the calculation process will include the discount security formula. So let's look at an example that will clear your idea about the negotiable certificate of deposit. Let's read this example. Bank credit card holders use credit card more often during the festival time, e.g. During the Christmas, for example. So the bank needs more money to repay this account during this time. Therefore, bank might issue certificate of deposit to attract institutional investors. So think about this situation. During the festival season such as Christmas, we purchase gift for our family, we purchase gift for our friends, we go for holiday. So during this time we use more credit card. However, whenever a holder of a credit card uses the credit card to purchase something, they do have the option to repay the money within 55 days and not paying any interest rate or any interest on the purchased amount. However, for the bank, they need to settle this transaction as soon as possible, and typically within 1 to 2 business days. So as a large number of people will be using credit card during the festival time, bank might be shortage of liquidity and would like to issue some certificate of deposit in the money market to manage its liquidity position. So who are the participants of the money market? The main participants of the money markets includes the commercial bank, the Reserve Bank of Australia, the Commonwealth Government, and the corporations. For example, as we already learned, there are several instruments that can be issued in the money market, and these are the participants. They issue this instrument to the money market. So how the interrelationship of money market interest rate works? Because money market securities are all very similar in nature, the yield trend to move closely together over the time. As we know, most of the money market instruments are discount security. The duration is typically 30 days to 180 days. The face value payable at maturity, and generally the selling price is below the face value, so the yield tend to move more closely together over the time. However, spread between the yield do arises from time to time, though the abnormalities are eventually removed by portfolio adjustment made by the sophisticated traders. So if you can look the yield of the money market, the co-movement of the yield of the money market, we can see that the money market instrument yield are moving very closely together over the time. As mentioned earlier, that there could be some abnormality for time to time, but for over the long run, all of the instruments yield move very closely together. Hopefully you like our lecture topic today and you learned something about the money market. Thank you very much for watching my lecture. If you like this lecture and the video, please do not forget to subscribe to my channel. Thank you.